Okay, let's get started. Welcome everyone to Neuravest's webinar, The Anatomy of an Intraday Futures Strategy. This is one in potentially a few webinar series that will come about. Our goal in this webinar is to essentially provide some of the foundational building blocks of what it'll take to really build a profitable and sustainable intraday strategy. As you may know, Neuravest does quite a few other things in its offerings arsenal, but today I wanted to focus on some of the more exciting and more applicable to today's market in the context of building a profitable and sustainable intraday futures strategy. A few logistics before we get started. We would like to try and answer as many questions as possible during and post webinar. We're going to have a session for that. Please use the Q&A tag or the icon on the bottom of your panel to ask some questions. We will record this webinar as well for future viewership if anyone would be interested. Again, our goal here is not to provide the details and the secret sauce per se of what really we've done behind the scene. For obvious reasons, we're going to try and keep those away from the context of the webinar, but we wanted to share with you some of the lessons learned, some of the things that we've learned, and potentially could help you identify opportunities yourself. And the last thing that I'd like to try to emphasize, we are going to showcase in real time our platform, trading one of those intraday strategies. So the idea is to really hopefully send a message that you really need to have a robust and powerful infrastructure to build these type of products in an efficient way, an effective way, and hopefully we can drive some of the message here as well. I'd like to also introduce some of my co-panelists today. We're going to have Taylor Korf, who is heading our R&D infrastructure. Many of the things you see here are a byproduct of his leadership, and he's actual coding. I'm also joined by Otar, who is going to be joining us here as well. Otar is going to essentially talk about some of the things that he has done, although he's a PhD and is a senior quant within Neuravest as well. Let's see. I'd like to also remind you that we are going to, again, answer questions. It's a 30-minute webinar, and we are going to ultimately finish the webinar with the Q&A. So we're going to get there pretty quickly, and we'll move into that as we go. All right, let's get started. All right, a few words about Neuravest. So essentially what we do is we are a financial research company, but we also work as asset managers to an extent. You know, we create and manage algorithmically traded portfolios powered by machine learning and data science. We have built a platform that can streamline alternative data and machine learning research to deliver a wide array of portfolio products at scale. We have three types of offerings: thematic portfolios. These are preconceived, intuition-driven ideas to invest, and then we automate them and obviously validate them and perpetually validate them with paper trading signatures on our platform and ultimately deploy capital. We also have Institutional Portfolio Plus, which is essentially combining multiple orthogonal uncorrelated portfolios together into a one multi-strat product. And the last one is Bespoke, which is essentially creating creating unique propositions based on client demand. So if somebody wants to come with an idea, and we can build something for them. Obviously, we also validate empirically and invest our own capital in these strategies. So essentially, asset managers can view our portfolios in real time, and we deploy our own capital for empirical validation. We sort of co-invest along with our clients in some of our products. So that's a unique, again, business value that we bring to the table because we are really putting our money where our mouth is. Okay, let's get to how do we do it. So essentially, the process is very clear. We ingest data. We have a pretty robust data validation engine. We validate it through our artificial intelligence, mostly superficially initially, to make sure there's no high degree of missing data. It's contiguous. There's no survivorship bias in the data. The data is sound, and it has initially, just by looking at some of the metrics, some predictive value. Once we identify that, we have about 12 checkboxes that we have to check and pass before we go to the next phase. We started going to scrubbing and aggregating, mapping to symbology, and of course, feature engineering, normalizing, ranking the features so we can actually compare between constituents, and of course, creating what we call a uniformly distributed data representation. So extrapolation and interpolation create some sort of a cadence of data that is common between different data sets, right? Sometimes data comes monthly, weekly, daily. In intradays, every tick or every millisecond, depending on what you look at. But we can actually create those aggregation, normalization to make sure that we can use the data effectively for our needs. Now, again, we're not in the high frequency play. When we show you today intraday, it's still decisions that are made through machine learning data research, but it's basically trading multiple times throughout the day, either 3 to 30 times during the course of the day, depending on the opportunities that the system presents us with. So we'll talk about how we do that. What's really important to note here that everything that we do is totally algorithmic. So humans are not going to be interfacing in a real-time scenario with these models, whether it's intraday or multi-day. It's all algorithmic, and it's all basically driven from our platform. So when we backtest a strategy and creating a model portfolio, that backtest, the same exact code, goes into perpetual trading on our platform, and the ability for us to sync in real time our model portfolio on our platform with any destination broker. So think about publish and subscribe. We publish from one source. That's where all the intelligence kind of resides, and we broadcast it to all the clients that are subscribed to these portfolios. That's our business model. I mentioned data science, which is a big part of our business. We've teamed up. We have some partnerships with some of the most exciting data companies in the world. And we aggregate the data in a way that can coexist. So we can create models that are driven from multiple types of data. Now, many of the things you see on the screen here, this is all the slide, are for multi-day, much higher latency type of investment. But we do use social media content, as well as newsfeed sentiment, and other types of intraday relevant information for our intraday models for the futures. And we'll talk about those as well. Last thing about kind of the process, when we evaluate a data set, whether it's intraday or multi-day, it doesn't matter. We break down the period in which we are doing the analysis to 4 distinct, non-overlapping timeframes. Essentially, the idea is to create a training set in which the machine is trained on. It's data that's given to the machine, it's trained on. And then we use different data sets, either sequentially following the training or some other data set, not necessarily sequential in time, but it's different sets that have yet to be seen by the training to validate that the models really work on a new set of data. Now, what's happening if you fail to validate, if the validation does not coincide well with the training, you go back to the drawing board and train again until they kind of have a very high degree of consistency between training and validation. If you do it too many times, you can be subject to something called selection bias. You try it too many times, eventually you're going to fall into something that doesn't mean it's sustainable. So the whole idea is not to overfit, not to create scenarios that are very specific. We want to try and get a generic association that can be working on any data. So what we do is we have one more yet set of data. It's called the holdout period, by which we test the training, validation. After the iteration, we check against the holdout. If that works well, we go into the last data set, which is the perpetual forward trading simulation, part of our platform. It's all paper trading, but it's real-time prices, real-time data. And if it works well, we start to deploy capital. So I'll show you today some of those pieces on our platform and how it works really well for our purpose. The whole idea is to create what we call a rolling training window, because again, with intraday specifically, you are working with multiple regimes, right? So you need to really train and validate on a roll forward basis, different regimes, different type of behavior, because the model that you have historically may not work well or future data. So you have to continue to reinvent yourself every time over and over again. Okay, let me pass the baton here to Taylor to talk about how do we go about developing an intraday future strategy. Taylor.
Thank you, Aris. Yeah, as I said, we're going to walk you through a general guideline of what we have built and how we go about thinking about building automated intraday strategies and what that workflow and thought process looks like. So this kind of is an outline of what we'll be talking about today. So let's start with the why. If you want to go to the first slide. Next slide. So the why might seem obvious. We want to extract alpha from signals and take a profit, right? But I think more specifically, the why is we want to automate that process. The process of analyzing and trading is a manual one, and because it's manual, that means there's a human factor there. And so our goal here is to automate and remove that human factor. Obviously, we are biased, we're emotional, we have to sleep, we have to eat. God forbid we do something else other than watch the market as a full-time job. Ideally, we'd like to take a vacation from time to time. So being able to automate away what might be a qualitative process into a quantitative one is a bit of a holy grail in some ways. Let's go to the next slide. Yeah, so there's no shortage of opportunities for extracting alpha in the markets, but understanding capabilities and constraints I think is a key to finding and exploiting actual attainable alpha. Without the proper analysis and the understanding of those constraints, what might appear to be profitable on paper generally isn't once you go live. So the first part of that is obviously identifying a proper asset. Futures is an obvious one here for a couple of reasons. One, they're highly liquid. It's easy access to leverage. There's typically a good amount of volatility, and even when there isn't, the leverage can make up for that. They're pretty inexpensive to trade, and they're 24/7 for the most part. Not quite, but and the reason that last part is important is because you want to have a tight feedback loop on whether something is working. So having something that's trading constantly allows for that, assuming you control for things appropriately. Machine learning is an obvious approach here because you want to have something that's quantitative. And I've identified these points below. Again, we're all humans, and we can't always be there to monitor and to make trading decisions. Next slide. Oops, I'm sorry. I got my slides mixed up. So I've already said this, talking about the flaws of human psychology bias. Again, the goal here is to move on to something where we are automated and not having to be present 100% of the time. I'll hand it over to Otar to talk about identifying relative assets.
Thanks, Taylor. So just wanted to add that basically as a machine learning company, we utilize both the traditional and the modern state-of-the-art machine learning techniques, right? So the ML component of our trading models helps to significantly enhance their predictive power, improve the probability of success, and properly manage risk. Essentially, machine learning allows us to capture complex hidden patterns in multi-feature data sets to construct forecasts where information based on technical indicators, fundamental factors, and alternative data get combined. Machine learning also allows for identification of different market regimes, as Aris mentioned, to adaptively update trading models' internal parameters as a function of time. So machine learning generated signals, as Taylor mentioned, avoid many of the human biases and emotional decisions to result in a winning long-term performance. I think we can go to the next slide. So feature engineering is a major component of building machine learning models. Some of the initial steps include cleaning and aggregating data and properly normalizing and aligning different features, as Aris pointed out in the beginning, as well as identifying which factors serve as the most reliable predictors in a training model. Instruments such as the highly liquid and volatile future contracts offer a rich data set for deploying machine learning models, along with traditional forecasting techniques that we use. I guess we can go to the next. Yeah. So any systematic trading model typically starts with a hypothesis that is rooted in some understanding or intuition of how markets behave. And statistical analysis of historical data helps strengthen or rule out a given idea. So we use rigorous statistical significance tests that are required to ensure that the observed results are not due to pure luck, that they're repeatable and that they're stable going forward into the future. Preliminarily, we use many different visualization and filtering tools in the early research stages to get a better perspective on the overall quality of the data and observe for any anomalies. I guess we can wrap up the slide. Many types of traditional and alternative data are being used to engineer features used by our machine learning models. So some of the typical ones will be the price, volume, volatility, order book data. Alternative data sources comprise news and social media sentiment, panel or transaction data, so on and so forth. These variables are all used by our machine learning decision makers to output a signal, which typically is an instruction to enter or not into a long or short position. So this is like a high-level overview of the mechanics and the workflow of our design of the trading strategies. I'll let Taylor take over.
Yeah, so machine learning is a simple concept for what we're talking about here, which is a supervised learning problem. We have independent variables and we have dependent variables. And another way to think about that is what information is going into the model and what predictions are coming out. I think one of the most important and critical parts of building any model is determining a proper label for predictions. And so in this case, we're talking about a classifier, and classifiers generally have a finite set of labels, is what we would call it. So in this case, it might be buy and don't buy, or sell and don't sell, or maybe it's a 3-class label: buy, sell, hold, etc. Determining that label is critical, and it's often a little bit nuanced. A simple approach might be, I'll just threshold out positive future performance, but that approach tends to lead to noisy labels, because any label that hits, maybe your hold time is 21 days. I know we're talking about intraday, but bear with me, I want to speak in regards to the chart here. Maybe your hold time is 21 days and any return greater than 0 is a positive label. Well, you may have a price action that loses money for the first 20 days and then slightly edges out a positive return on the 21st day. I would call that a noisy label. That's not something that we necessarily want to encourage the model to learn. And there are a lot of examples like this. It may be a case where the price action is incredibly volatile and it oscillates back and forth between being positive or negative and ends positive on the last day. Again, that's a noisy label. Another approach or an intuitive next step might be to raise that threshold a bit. Maybe we can say, well, I need to achieve at least X% returns over this time period to consider it to be a positive label. The problem with that is it doesn't correctly adjust for volatility. And so if, for example, I'm training a model that needs to learn both Apple and maybe a less, or maybe a less volatile stock like, trying to think of something off the top of my head, like GM, depending on the time period, that model is going to have a hard time generalizing between the two. So something that we commonly do is we will normalize our labels for volatility. And the idea here is, given some sort of look back period where we sample variance essentially or volatility, let's adjust our thresholds for this look forward to generate a positive and negative class. Again, creating label is the most important step in my opinion. And my general rule of thumb is to ensure that the positive labels obviously need to correlate to positive returns and that the labels are properly accounting for non-stationality volatility as a given example. Next slide. Now I'll hand off to Ayers here to briefly talk about execution logic and trade management.
Thanks, Taylor. Thanks, Otar. Great job. So essentially, here is the meat of this presentation. You know, for you to create a profitable intraday strategy, there's really 4 layers of information you need to be applying some sort of a technique for. The first one is the first layer, which is one of the questions that I just answered in line from the Q&A. People were asking me, if you're using technical indicator, and there was already arbitrage, why do you want to use those? So essentially, we use multiple layers. And the first layer is technical in nature. It's a signal in nature from technical indicators. The factors that we talked about before are pretty much what you have to play with. It's price volume factors, different types of nuances of that, but also obviously some alternative data that provide maybe some higher level overall directional kind of overlay before you get into the, subsequent, signals where you're going to go long or short, whether it's a momentum or mean reversion. These are the things you have to play with. But the signal is the first layer. The signal then gets confirmed with probability with the machine learning model. So we use multiple techniques. We use deep learning techniques as well as traditional, as Otar mentioned. Deep learning, because we think deep learning is great for intraday, because one of the biggest challenges with deep learning in financial markets is when you go into multi-day strategies, the number of data points, number of observations are rather small for a real good deep learning framework to take advantage of. With intraday, when you have tick data, the numbers are much, much greater, and you have a better chance to really train a machine with deep learning technologies, whether it's transformers, whether it's computer vision, whether it's RNNs with LSTM. There's a whole bunch of techniques, old ones and new ones, that are very suitable for that type of data. So once you have the signals, the machine learning on top of that is an overlay, then you get into what we call trade management. And that's, again, each one of those levels has a whole technique and machine learning applications that can really optimize any of these. But trade management is, how do you allocate your entries and how do you allocate your exits? Are you buying all in and out in one shot, or are you getting multiple legs to come in and come out to mitigate your risk and maximize the return? We'll talk about that as well. And obviously the exit criteria. How do you do stop gain, target gain, or stop loss? How do you find the happy medium between those to maximize your profitability and minimize the inconsistency, which is the biggest challenge with the intraday, the inconsistency of returns? We'll talk about that in a second. And of course, the last level, which we found to be very useful, above the trade management is what we call the actual P&L management. So assuming you started the day and you are making very nice, strong returns on your portfolio, and then suddenly things turn around and you kind of given up all your trades. The same way you have a stop loss on your trade, you can put a stop trade on your entire portfolio and manage the P&L to ensure that what you gained is not going to go away. So these are all techniques that we've applied in different levels to create really a holistic, profitable, sustainable, consistent portfolio. Okay. So this is maybe Taylor can jump in here. This is about evaluating models and how effective the model is.
Yeah, taking a step back from kind of the execution and trade management side, when we build a model, it's very important to evaluate it on a separate set of data. We usually call this a validation set or maybe a test set. And the idea is to determine if it's actually learned anything or whether you've really just overfit to your training data. Again, in this specific example, today we're dealing with a classifier. So it's a binary classifier, meaning that it has a positive and a negative class. More simply put, the positive class, in this case, let's say it's buy, and the negative class is do nothing. So there are several metrics at our disposal to evaluate whether the model is useful. The most obvious choice might be to look at a model's accuracy, but some problems might benefit from focusing only on actions that we take rather than the missed opportunities. So accuracy isn't quite what we're looking for. For that, we might instead look at something like precision, or hit rate is another word for that sometimes. So of the trades we took, how many were good? In trading specifically, we tend to want to minimize our false positives. It's generally desirable. And in most cases, that results in an increase in false negatives. So a good way to evaluate and visualize this is an ROC curve. ROC stands for receiver operator curve. The origins of this are actually from World War II, where it was used to identify radar signatures and classify the likelihood of it being an enemy aircraft. Since then, it's been adopted to other domains and a wide array of classification problems. But generally, where you want to try and control the separation of a positive and negative class, it's applicable. And it has a bunch of other great properties, which we won't get into. It's a little technical, but one example might be if I was testing for a deadly disease, false negatives are absolutely a horrible thing to have. I don't want to misclassify someone as being healthy when they're not. Whereas in trading, again, we want to minimize our false positives. I don't want to take bad trades, even if that means being on the sidelines for a missed opportunity. Losing money is obviously the worst case scenario here. So if we're looking, and I'll just try and briefly explain what this looks like. So this plot down below shows two models. The charts on the left, ignoring this, the grid up above, ignore that for a moment. I'm talking about the plots on the bottom. The chart on the left would be an example of actually a model that has not learned very well. And you can tell this because the two distributions, the blue and the red one, kind of overlap. Those distributions represent the negative class and the positive class. And the separation of those distributions is how well the model is learning those two classes. When it can separate them, that's a good thing. The charts on the right are an example of good separation. And the idea here is that I can draw a threshold or a vertical line that splits those classes. And the better that line can split, the better the model. So in this case, I might set, talking about the models on the right, I might set for a trading model that vertical line at the very right edge of that blue distribution so that I don't have any bad trades. And obviously that's not always possible. The models tend to look like something a little bit more in the middle of these two, but the real world is always messier than practice. Next slide. So back to errors for this slide, and then I'll
let me talk about some of the things that I mentioned before. The entry and exit signal detection, the AI model will further confirm the signal, the trade management, and the PLN management. So I'll give you an example. One of the things that Taylor has done for our company, we build a really robust infrastructure that can do things that are what we call broker agnostic. So think about it. The whole idea is that we don't rely on any specific functionality that the broker gives you as far as order management, as far as trade management. We do it all pretty much on the model itself that allows us to create one single source code and connect to multiple brokers and only do the buy and sell through them, which is the fixed API, very simple functions, and all the complexities are really sitting on our end. So I sent a few articles before this webinar talking about some of the techniques that we've been applying. I just want to mention here one of them. You can see kind of what I've drawn on the screen here. So, somebody asked me about trailing stop losses and stop gain. How do you go about doing it? Obviously, the model has a prediction. You want to make sure that you reach that prediction, but if it goes against you, how much time do you want to give? How much pain are you willing to endure before you can get back and give up on the trade, right? Because the idea is that nothing goes up in straight line, nothing goes down in straight line. When you actually predict something, you got to give some time or some freedom for the market to get there and not expect it just immediately to start shooting up in straight line into your target. So it's a fine tuning of how much pain are you willing to endure and what's the probability of success that it'll reach eventually the price target given a stop loss condition. But one of the things that we do, the naive way of doing a stop loss is just a fixed number, 2%. I cannot take more than 2% per day. That's my personal, pain point. I'm going to put a stop loss at 2% and that's it. Obviously, that's not ideal because market regimes change, volatility change. 2% may be good for one market, not for another market. It should really be a function of some other factor that is more dynamic in nature. And we call it the trade range. You can see essentially what you see on the screen here is a method that we build in-house. And it's basically a trailing stop loss that basically can be determined based on the volatility of the market at any given time, but it's not a fixed value. So you can see, for example, you can start with a 10 bips max drawdown on the first leg here. But as your returns, that orange line represents returns of the trade itself. It's the actual trade. As a trade starts to move in favor of your direction, the stop loss starts to shrink. In other words, the pain point that you're willing to take is going to be smaller and smaller as to preserve what you've already earned and not get knee-jerked out. So the idea is to eventually come out with a stop loss, but it will be so small that you've already realized most of the gains, and you basically are doing a trailing stop loss with a decelerating stop loss level. So it gets higher and higher as you make higher return. Now, this functionality is not available in any broker in the world. I'm not sure which brokers even have it or not. It's built on our system, and we can apply all the logic on our model portfolio and ultimately synchronize in real time. It's really milliseconds worth of time frame that the portfolio sends the instructions to update in the broker side, whatever gap or difference between what it currently has and what the model represents. So a new buy would be a new buy, and we can scale the number of contracts that are being bought or being sold automatically based on the AUM at the destination portfolio or the net asset value of the destination portfolio. So that's just one example of how we do these things at Neuravest. Let me get back to Taylor to talk about some of the more advanced reinforcement learning technique for again, exit criteria analysis.
Yeah, so I mentioned before on the labeling slide that I consider labeling to be one of the most critical parts of building a supervised model. And something I didn't mention, but maybe it was a bit implied, is that you have to train like you trade. If you are putting logic after the fact that highly obscures your training performance, then you're probably going to have a bad day. The problem is it can be really hard to encapsulate and bake in a lot of how you might manage a trade into the labeling process of a supervised model. So again, supervised learning is where we tell the model both its inputs and what the proper output would be, what it should be predicting. But another form of machine learning is called reinforcement learning. And maybe you've heard of it. It's actually pretty popular on the cutting edge of a lot of the big things like AlphaGo, and any model that's learning how to play chess is typically, or any sort of game environment is typically reinforcement learning. But the idea is that it works by learning a policy that takes actions to maximize some reward. And it's particularly useful for when that reward is cumulative in nature and may not be realized until a future time, hint, hint. So obviously for that reason, it's a very clear application towards trade management. Similar to supervised learning, reinforcement learning takes inputs. These inputs might be variables that describe the state of the trade. For example, the unrealized gain, the volatility, the liquidity, trade duration, leverage. And so like during a trade, there are several strategies that we might take to manage profit and risk, but almost all of those strategies take the form of two actions: buying and selling. Technically, there's actually a third action, it's doing nothing. The reinforcement learning model needs to be aware that that's an action as well. Again, these things are, you have to tell it that, it doesn't just know that by default. So when the model sells or closes a position, we might give the model a reward based on unrealized gains. But while the model is in the trade, we might not tell it anything. And we might tell it, okay, you haven't realized any loss or gain at this point. And the idea is that the model can learn actions that achieve future rewards. That reward, by the way, which is going to be, or I guess when the model sells, it's realizing a gain, right? So that reward might be offset by things like simulated slippage, commissions, volatility, opportunity costs. Just sitting there and going flat all day is not a good thing. We shouldn't give a reward for that because it takes 3 hours to get 5 basis points of return. So the most important thing is that we're giving, obviously, the model an accurate representation, not just of that trade state, but also of the proper reward. And if we do that, the model should learn how to manage trade and maximize the potential for profit. Note that we need to be careful about how we construct that reward. For example, if we failed to properly account for slippage or transaction costs, the model might simply learn to take profit as soon as it's possible, as soon as it's available, regardless of the size, which is obviously not desirable. So key takeaway here, in a supervised learning problem, it can be difficult to bake in a lot of the real world trade management realities into it. With reinforcement learning, we don't necessarily need to know if at this precise minute the correct action was to buy or sell. We can just tell the model that was a good trade after the fact and let it manage the trade in real time.
All right, it's back to me again. So one of the things that I wrote about in my last article is about inconsistency of returns. You know, I've seen so many times, and we've been, playing in that space for quite some time. And I've seen other quants and even internally, we had a great strategy. It works beautifully, just as advertised. And we go home and you say, man, I can't wait for tomorrow. It's been working just so perfectly. And tomorrow comes and everything falls apart. Nothing works the same way. It's the same model. Seemingly market looks the same and it just doesn't work anymore. And it happens more often than not. It's the most frustrating thing for a quant to work so hard, getting a model to work, feel the amazing exuberant when it works exactly the way it was designed, and then realize that there are days in which it just doesn't work. So we try to really spend some time to identify how do we create that consistency. And I wanted to share that with you because I think it'll save you a lot of headaches if you are a quant or if you hired a quant to work for you. One of the things that mentioned before are the obvious suspects for lack of consistency. Overfitting. Overfitting is basically a model was trained to be a very specific scenario that looks good, in training. You maybe get lucky in the real world and you got very similar scenario, but these scenarios don't repeat themselves very often. It's not generic enough, and therefore you would fail miserably in most cases. Next one is path dependency. So, remember, we are trading in and out of positions all the time. We can go long or we can go short. We have multiple models usually that work in harmony to create those relevant scores and probability score of which direction should you take and what should be the trade management for that trade. There is a notion that if you entered a long trade before you enter a short trade, just from sheer timing perspective, the sequence of the following signals could differ depending on when you enter during the day. What is the point in time of entry? And you want to definitely avoid that. So the path dependency or the state dependency should really be something you should look very carefully at, because that would create scenarios that you just sheer luck. You were entering a position long before you entered the short, and then the sequence of behavior is totally different than if you had entered as a first trade, a short trade. So again, keep that in mind. And we've fought hard to make sure that no matter what time of the day you would enter or you start the algo, it'll behave the exact same way on a one, trade at a time. The last thing is luck. And I have to say that many times you see trades kind of working because you just got lucky. And, luck has a tendency of running out sooner or later. And you just need to be aware that, your statistical analysis, your scores, whether it's precision or F1 or just a win-loss ratio, all of the things that Taylor was talking about, how to evaluate the efficacy of a model through confusion matrix or ROC curve, that's what's going to drive the sustainability and the confidence in the model. But the most important thing, in my opinion, is to create what we call regime agnostic models. So think about it. During the day, if you're an intraday trader, there are multiple types of behavior that you see. For example, the simplest thing is, you see the market at the open of the trading day is totally different than what you would see around lunchtime at 12 noon, or when you get into the close. Volatility changes, activity levels as far as volume changes. I mean, trying to build a model that basically works on all these regimes, even intraday, is a fallacy to think that a model can really adjust itself individually to be a best fit for each one of those scenarios. So what actually happens, you build a model that is designed to create some sort of a fit a line across domains that are completely different from each other, and it ends up compromising the pure value of the model. You're trying to be all for all, and it creates an inferior, lowest common denominator kind of model. The best way to do it is to identify the various regimes within the day and identify what constitutes a regime, what type of values that you look for to make a regime, and then apply something called unsupervised learning. This is a clustering technique that allows you to identify what type of regimes, based on the factors that you identified, are most suitable to determine a day in a day trading world. Well, that applies to multi-day as well as and longer-term strategies as well. But essentially, think about it. You're now building and you're training models on data that's only regime specific. So you have a different model potentially for the opening of the day, or you have a separate model for the close, or separate model for the middle of the day, where the volume is not as robust as the other. And you can see how the models shape up. And at the end of the day, you'll have an orchestration level, something from the top that says, okay, which regime am I currently in? And what is the model that I should deploy? Only deploy these models that are meant to train on that regime kind of data would be applied. And that would create a much greater consistency, because if you have a day that looks totally different than the previous day, you will know the models that needs to be applied, as opposed to try to create a single model that basically fit the common denominator between multiple regimes. So that's really important to make. If anything else you can get out of this webinar, I encourage you to look very carefully into that, because that's what's going to make you more consistent. Anyway, let's get to the conclusion. I wanted to show you the platform real quick here, and hopefully we'll have some trades to look at in real time, but we'll see in a second. This is just a back test. Again, looking at the 1 minute bars. So we're looking at, we have built the multiple products here. One is with the NQs, the NASDAQ futures. We have also the Russell 2000 futures, the E-mini for the S&P 500, oil futures as we mentioned before, and actually we're using some of the VIX futures as well. So we are really looking at applying this technique on multiple constituents because we think there's a lot of opportunities in these volatile type of instruments, and losing futures is really attractive for us because it creates that leverage. And if you have a predictive signal, it can become very profitable. We also go both long and short. None of our strategies is one directional. So we can definitely determine which direction to go and go after those trades, and also stay in cash. You don't have to be always trading. It's very important to note that putting the money and waiting for the next signal in high confidence is completely fine. You don't have to be always in a position. So you'll see now, as you get to the demo, how we go into spurts of lots of trades in a very short amount of time, and he goes into a sleeping mode after that. Okay, let me see if we can get this going here. So what you see here is actually our platform. This is the Neuravest platform. Just to give you an idea, there's a bunch of model portfolios that we have here. Each one has its own set of rules, set of configurations that are working in real time. Obviously, the market is down today. You can see these are positions that are currently being held in this portfolio. These are different constituents, but let's just pick up one of those models. Actually, I think we're in a trade now, which will be nice to see. This is the Russell 2000 machine learning. I'm going to quickly shift the screen here, and you can see these are trades that have executed already earlier today. And a trade contains multiple legs. You can see when you enter a position here, this is a buy and there's two sales. Here's another buy and two sales. Here's a losing trade. You can see a buy and everything kind of went out the other direction. Here's actually a winning trade information as we speak to, and this is actually even a greater winning trade, which is multiple legs. So you can see this portfolio really moving in real time. I'm going to try and kind of update the P&L for you so you can see what's going on. So you can see here at 12:32, we entered a long position with the Russell 2000. Exited very shortly after with half of the amount after we made profit. You'll see in a second what it is that we made. And then you can see that we exit up again. See those trades, these are all profitable trades. They all accumulate 8 bips, 5 bips, 1 bip, 5 bips, 3 bips. That's kind of how it adds up. What's happening here also, it sees, this is the trade management I was telling you about. It sees that we are going in the direction of the trade. So rather than closing the entire position, we're ratcheting it up back to 100% here and continuing our trade management to see if we can actually capture that longer term momentum as opposed to get out of trades too soon. So you can see here, we actually went up and we closed the trade, and we're entering now another trade right after that. So this is pretty much an active time frame for the strategy to work. Now you can see what's happening here. There are some losing trades. It's not always winning, but the winners are, number one, greater in numbers, but also greater in size as well, for the most part. So how do I know that? Because we have a report that we generate. This is, by the way, the report of the strategy since July 6th, since, actually July 5, after a day after July 4th. You can see the strategy, this is live, is up to 2.1%. This is the notional. Remember, the Russell 2000 is a 50x leverage. So what you see here is the notional increase, but depending on how much money you put in, the values will be much, much greater. If it's 10x levered, it's going to be 20%. If it's 20x, it'll be 40%, and so on and forth. So it's big numbers that, depending how much risk you take and how much leverage the broker is going to give you. But what I want to show you more specifically, this is a long short portfolio. You can see winning days. The benchmark here is irrelevant. It's the S&P 500. It's not really material for our comparison purposes. But what I want to show you here is the trade analysis. So we capture everything. We are a big data analysis company. We analyze our own data very effective. So you can see, for example, how many trades we had in the last week. So 535 trades, you know, it's quite a few trades per day. How many long and how many shorts? And what is the win-loss ratio between long and short trades? Now, I want to remind you, this is past slippage plus past transaction cost. This is basically the net return of these trades. And you can see that totally, and on average, we are 67 to 33 win-loss ratio. We get sometimes at 70-30. I mentioned in one of my write-ups. So it's a little bit less than that. The last few days were not as maybe win-loss ratio successful, but you can see that we're still having the odds totally in our favor. These are successful trades on the left side. On the right side is unsuccessful trades. And you can see that we have much more successful trades against one that are unsuccessful, but also you can see that the average gain on a trade that's successful is 10 bips, and the average loss on a unsuccessful is 6 bips. So we have less unsuccessful, but even the one that have not been successful are losing less money compared to the one that have been successful. That's a recipe for profit. And that's what we are analyzing. And that's what I'm showing you right here on that screen in real time, as trades are completely materializing. Our platform allows us to view all the orders that were executed throughout the day with a pretty good, these are all connected in real time to, again, a broker of your choice. And of course, it moves into the transactions themselves. And of course, ultimately, the holding and the performance of the portfolio. Anyway, we have a lot more to show, but hopefully I've given you a chance to kind of understand what our platform does, and gives a chance really in simulation, paper trading simulation, to see how things are working, and obviously in real time connect to a broker account and completely trade it live as we need to turn it back on. So anyway, I wanted to show you that. Hopefully it was useful. And I know we have a few more questions on the Q&A here. We'll give a chance for our team here to answer these questions, and we'll be done with this webinar. So maybe Eric, you can field some unanswered questions for us to respond to.
Sure, I think we've got most of them covered so far. We will share a link to download the presentation afterwards. That one is still up.
Let me, Eric, share some of the questions you already answered, just for others to know. Somebody asked if we had built our own backtesting engine. Yeah, everything you see here is built in-house, right? It's built completely in-house. It's all maintained through our code. We are software development, experts, as well as machine learning and data science. So we apply all of these tool sets internally for our research.
Okay, here's another one. I didn't understand the difference between trailing stop loss and decelerating stop loss. Could you provide reading materials on decelerating stop loss?
Yeah, I don't have, it's basically we build custom here. It's for internal purposes. It's not something we sell to others. I mean, if you want to engage us, we will have to build basically together a strategy for you. We do it with many, many clients that have an idea, and we build it with them and kind of partner with them on these on these new products. But in the context of the trailing stop loss, so think about trailing stop. Let's say it's a 5% trailing stop loss. What it means is that as soon as you make a new high, the 5% is measured from the new high. So it's trailing along with your success. You have to be coming down 5% from the highest point since you entered the trade to basically realize that trailing stop loss. The decelerating stop loss says, if I make 20 bips and I had the 5% stop loss, if I made 20 bips already in my trade and I have a new high, my trailing stop loss is now 4%. And I make 20 more bips and my trailing stop loss is 3%. If I'm making another 20 bips, it's 2%, and so on and so forth. So the idea is not that you are readjusting your stop loss based on the new high, but you are shrinking the downside opportunity because you want to preserve what you made up to that point and not let the entire 5% go down from the top. you want to have a smaller drawdown to exit that position. Hopefully it answered your question.
Okay, we've got another here. It is, how do you decide the time for the training window? For example, 2 weeks or 2 months. My model outputs 3 labels, buy, sell, hold, but the feature importance shows the ATR and vol are the most important by orders of magnitude. Other features don't really show up. So I guess that's kind of a 2-part question, but the foundation there is, how do you determine the length of your training window?
Yeah, it's a good question. I'll let the quants kind of chime in between Otar and Taylor without giving away the secret sauce. So just conceptually, please, guys, if you don't mind.
Sure. I think to that specific question, in order to have price movement, you must have volatility. So it makes sense that volatility would be one of the leading factors in your model. I mentioned before that it's a good idea to normalize volatility out of your labeling. So I would recommend doing that. Doesn't mean it shouldn't be there as a feature still, but I think if you want to give other features more importance, that's probably a way to go about doing that.
Thank you. Otar, anything you wanted to add? I guess not. Okay, next questions, Eric?
Yeah, do you use AutoML?
No, not generally. I think having a hypothesis going into a problem is key. I mentioned that there's tons of alpha that can be extracted, but blindly going into a problem and expecting the machine to solve it. The problem really why AutoML doesn't work for finance is because there's not enough data. There's not even close to enough data for a true, deep reinforcement learning approach. So yeah, treating it as a black box generally leads to something, but not something that works in the real world.
Okay, and I think that brings...
I guess I can chime in on the beginning part of the question was how to decide the time for the training window. And part of it has to do with the time, the frequency of trading and the granularity of the data. So a machine learning model that generates signals on 1 minute intervals versus on 1 hour or daily will obviously require different historical look-back periods. If we're in a regime where a signal is generated on a minutely intervals, even in a few days worth of historical data, there could be patterns that are identified by a deep learning architecture. Whereas if a signal is generated daily, obviously we'll need much longer historical period to look at. So it really depends on both the frequency of the given model, possibly also volatility and other factors, but they have to kind of align with the time regime that is used to build a given predictor.
Thank you. I think that brings us up to speed on questions.
Yeah, thank you, everybody. Thank you, Otar. Thank you, Taylor and Eric, for helping me officiate this important webinar. I hope the people who have joined enjoyed it.